So there's a bunch of investors tuning into these conversations, and maybe a bit of a populistic question, but how can they, separate DHT from Frontline, Okeanis, and other players in the market? One thing is, of course, the listing. You're not in the Oslo Stock Exchange and stuff like that, but how do you frame it even if investors give you a call and want to look at crude markets and who they're going to invest in?
Yeah. Of course, this is a recurring question and important if you're going to invest. So all these companies are different, as you say, and I shouldn't say that they're necessarily better or worse. But the structures of the companies and strategies will, of course, behave differently at different times in the market. So first and foremost, we are a pure play company. It's only VLCCs, which is the workhorse of the crude oil market. So about 50% of crude oil, seaborne crude oil transportation is handled by VLCCs. So it is really the most important asset. It also works, for long-haul transportation, all of that. So pure play, that's one. It's a very simple capital or corporate structure. So everything is integrated. There's no private-public relationships. It's not like management owns a management company on the side and charging fees and all that. Everything is integrated. So when you invest in DHT Holdings, DHT Holdings also owns the management companies and everybody's employed in this. So, economics are fully aligned on all fronts. Then if you look at our corporate governance, it's a very high governance standard. And I think sort of neutral reference on that is the Weber scorecard, which is a US consultancy firm. Started by Michael Weber. He used to be head of transportation, sales side analyst with Wells Fargo. And he started this idea that if he could measure corporate governance, he could also look at returns over time. So in this Weber scorecard, which is coming out every day, every year, we are consistently in the top quartile, and we are the highest ranked of the crude oil tanker companies. So this is sort of a reference for corporate governance and integrity, how the business is run, right, on behalf of the investors. But then on to the key business things. And running a shipping company, to a great extent, is about how you allocate capital. Because it's a very capital-intensive business, there's a lot of money involved. And there are essentially sort of 4 ways to allocate capital. 1, you can invest in ships. 2, you can pay dividends. 3, you can buy back stock. Or 4, you can prepay debt, i.e. more than what is amortized, so to invest in your balance sheet. Those are the 4 sort of areas you allocate the capital. So how a company is doing that and how it's structured to be able to do it over time is the key. And I think DHT, we are put together very well on that. I would like to think that is well thought through, of course. So our dividend policy is to pay out 100% of ordinary net income as quarterly cash dividends. But the reason why we can do that is because we have little debt, and there is a meaningful headroom between the P&L break-even and the cash break-even. Because if you have a shipping company, if you pay out all the cash flow, that's a disastrous decision. That will end in tears at some point. So we have this headroom, which means that every year, despite paying out all of net income, we still generate quite a lot of cash that we can use for the other 3 areas of allocating capital. So if you look at us now over the last, say, the year or so, we have deployed most of the cash flow into our new building program. So it means we have ordered new ships without raising new capital. In December, there was a very soft patch in the stock market where our share price dropped quite a lot. So we bought back quite a lot of stock, very cheap, below $9. So these are sort of examples of things we can do without hampering the dividend. So we did a thorough analysis on how to structure this and how to have confidence that we can live with this over time. Because to announce a dividend policy that for some reason has to be changed after 2 years does not build confidence in the market. So I think this model now is now increasingly being rewarded. We are trading at a premium to NAV, which I think is fair. Because it's not only about the value of the assets in the company. Hopefully, investor will also value the soft parts of the business. The people that work there, the value of customer relationships, of lending bank relationships, and things like this. And that has a value. That's part of creating value in the company. To build up this, I think, is a very clear strategy. And some people in New York at some point told us, say, you know, what's wrong with you guys? You're just doing what you said you're going to do. And that gives you a little bit idea about maybe what is the experience investors have with other companies. So
that's a fascinating breakdown. But this model also provides excellent discipline as well, that makes you
Indeed.
do the right decision, because maybe that's the hard part as well, that you are, you know, yeah.
To stay disciplined, yes. I mean, you know, history is full of people and companies that got carried away, right? And you know, it's shipping in at times you can be very excited about things, but you know, when you have a structure and plan how to do things, and you know, sometimes you have to tune a little bit because maybe circumstances are a bit different, but broadly the basics are in the pillars are in place and how to do things, and we will stick to our knitting, as they say in Britain. So.